I'm Peter White. Welcome to the Inside Network. Welcome to In Depth. I'm Peter White, and my guest today is Cory Martin, CEO of Barrow Hanley, part of the Perpetual Group. And today we're going to discuss the intersection of value and the changing market environment. Welcome, Cory.
Thank you, Peter. Glad to be here.
Could you provide some insight into the unique approach of Barrow Hanley in terms of your equity selection process?
Sure. The Barrow Hanley Global Value Strategy is what most of our clients consider to be an anchor to value. And what we mean by that is the strategy is designed to keep you in the game year after year. And let me explain what I mean by that. Within value, you've got a spectrum of different types of value. On this far end, you've got deep value managers. They tend to be invested in companies that are really cheap. Maybe they're in the ditch. There's some problems. Maybe they've got high cyclical exposure. So this tends to be performs very well in up markets, but it catches a lot of the downside market. On the other end of that spectrum are defensive value managers, and they tend to be buying sort of higher quality compounding defensive names. And when the markets rally, they underperform. When the markets go down, they outperform. These two ends of the spectrum tend to perform like this. Our strategy gives you exposure generally in a range from 40 to 60% in this spectrum between cyclical names and defensive names. And by not being out on one end of the curve or the other of the spectrum, it tends to provide a more consistent alpha generation on a calendar year basis by keeping you in the game. And it's important to understand how we migrate the portfolio between these, and it's completely bottom up. And so we're looking for dislocations, where are the values now, and where do we need to go? So let me give you an example. 2015, U.S. was out of favor. U.S. banks were horrible, really thrown out, very cheap. We began buying into the cyclical U.S. industrials, overweighting this area of the market. We were a little bit early, but that was all bottom-up driven, and we began selling some of the more defensive names that have done well. In 2016, latter half, in 2017, you had Trump election, corporate taxes went down, Macron was elected in France, very positive for the market, huge rally in our cyclical exposure. And what had been left behind, some of the defensive names looked really cheap. So we began aggressively rebalancing, taking profits in a disciplined manner out of the cyclical into the market, redeploying those into defensives. And that's how we do year after year. We're very disciplined in our capital allocation, and it creates a portfolio that's asymmetrically positively skewed and provides a smoother return and tries to avoid these boom-bust cycles of a lot of value managers.
Barrow Hanley's got a history of over 40 years. I think you've been in the business for 20 years. How has the value approach changed in your time?
The underlying principles of buying assets and earnings below the market, temporarily good companies that are down, that philosophy has not changed. With the evolution of sort of instantaneous information flows with the internet in the mid-90s and other things now, in the old days, you could buy a good company that it stumbled, like maybe they missed a product cycle, maybe the management did a dilutive acquisition, it was a mistake. It's still a good company, and it just got hit, and the stock price was depressed. You could almost buy that just for the mean reversion trade. The mean reversion trade, those days are over. So now it's part of it. You still want to get a mean reversion on an undervalued company back to what it should be priced at under its true earnings power. But now you really have to have multiple catalysts in order to win. It can't just be valuation. You need multiple other ways to win. And I would say the second biggest change, and it may even be the first biggest change, is understanding potential technological disruption on the businesses that you're buying. And you used to not have to think about that, but if you've got an industrial company or if you've got a financial bank that's got a big payment system, you need to make sure that payment system, if it's significant, is not going to be dislocated by a up-and-coming new tech name that's going to damage those earnings. So I think looking at technological disruption has become very important.
I think in short, you're saying it's also more difficult to be a value manager or more exacting? Would that be fair enough to say?
I think it is, not only in value, I think everywhere. I mean, this mosaic of information that you're having to process now is just more complex than it's ever been. And so it is harder in value. It's harder in growth. It's harder everywhere with technology, I would say.
Well, repeatability of a business like yours is important. How do you achieve that, and what processes and practices do you have in place to have that repeatability factor, which underlines many successful businesses like yours?
Yeah, I think in portfolio management, portfolio construction is very important in order to inform you and provide repeatability. And we are very disciplined in building portfolios at the stock level, monitoring each of our holdings, measuring our return on invested capital since inception, and measuring where are we with the performance relative to the price target, assuming we were getting it right. And if we are approaching the price target and we've had good return on invested capital for that particular name, we're going to redeploy that asset either into a new name with a much higher upside or an existing name within the portfolio that has not worked, but our thesis is still intact. And so by following this in a very disciplined manner, it's kind of like I said earlier about going where the value is and migrating the portfolio. We're doing the same thing from a capital allocation standpoint. And if you're disciplined and you follow this methodology, it will keep you in the game year over year.
That discipline, it sounds like to me, don't get attached to your successes.
Right. Yeah. Analysts oftentimes will get attached, and we have to sort of bring them down to levels that are reasonable.
Well, traditional value over recent times has underperformed slightly. That you guys have done very well. How do you explain that you've occupied that part of the value sector? Is there any secret sauce?
You know, not really. I think we have been able to achieve a differentiated source of alpha. So I think if you think about that, it's a good point you're making. If you look at over the past 5 years, your typical value manager's performance, you almost can determine what they were holding by their performance. So if they were great performers, they probably had a lot of FANG stocks, and we're finding that. So we've got competitors that are traditional value that had over 50% in, growth names. We have actually been able to keep up with an underweight to tech because we couldn't find the valuations there, yet we still generated alpha. And the way to do that has been just from a bottom-up standpoint, picking good names that provide good stock selection alpha.
We talked about the amount of information and data in the marketplace these days compared to the past. How do you filter out what is noise or counterproductive or non-productive noise versus vital information? Do you have any systems or an approach or a mental state that gets rid of the rubbish and lets you focus in on the key issues?
Yeah, we do. You're hitting on a very important point. In the investment management business, time management and filtering out the noise is the hardest thing to do, and it's the most critical thing to do. And so because of the fact that we're in Dallas, Texas, which is not in New York, so we don't have the mafia, the hedge fund mafia, and a lot of noise swirling around. That's the first point. Second point is when you're a value manager that does all of your own fundamental research, we can kind of ignore the noise. I mean, we're building all of our own financial projections, all of our own EPS, ROE projections, and really making our own independent decision. And so we're able to work through this noise that a lot of people get caught up in.
Value investing traditionally relies on the re-rating of companies. I guess it goes without saying, but what do you see as the most persistent traits of companies that are able to be re-rated?
I would say, we're not necessarily looking for a value company. We're looking for really instead open-minded on where the value is. So oftentimes re-rating is important. It does rely on re-rating, but oftentimes we'll find a company that actually is a fallen growth company that has stumbled and it's now available for purchase at value prices. So I think we remain very open-minded and we don't myopically follow valuations, because if you myopically follow valuations and you classify a company because it's cheap as value, you'll set yourself up to be caught in some value traps. And so we try very hard to view every stock in the market as a potential value if we can buy it at the right price.
And is there any particular traits that you've experienced in history that's what helps the company re-rate, like new management or a change in the cycle? I mean,
it can be any of these things. It can be, we followed a CEO around to at least 3 companies who's been a proven record of, huge returns on his invested capital. He's a big investor. So it could be management. It could be recapitalizing the firm. It could be product cycles. Our focus when we meet, and we're looking for these catalysts, is we meet with a CEO or CFO. We go, okay, we've identified 5 problems. 3 seem to be secular. How are you going to get out of this? And 2 seem to be cyclical. So we think those earnings are going to come back. But these 3 secular problems convince us that they're not going to come back into your earnings. And almost like a private equity firm. So we're looking for catalysts. I said earlier, multiple ways to win. And it's not just valuation, but we want to make sure that we understand what the strategic initiatives are for the C-suite at any company we invest in, and that there's a clear, articulated plan on what is the strategy to turn this around. And most of the time, we have to agree with them in order to hold the stock. And by doing so, we're almost like partners, strategic partners with a lot of our portfolio holding companies, because we're actually working with them. We've been in the business a long time. We're on our 4th generation. We understand the levers that are going to drive a business to profitability. And so that's why we tend to hold things in anywhere from 2 to 4 years.
And does the management of those companies appreciate what's the dynamic like between the management and you guys? Yeah,
they do appreciate it. They will always meet with us because we tend to be strategic thinkers and good strategic partners. It's the opposite of a hedge fund. So most of the time they won't meet with a hedge fund because they're not doing that. We, as I said earlier, approach things almost like a private equity firm. And so generally they're very open. Of course, they follow regulations on what they can disclose, but they tend to view us as strong and valuable partners in what they're trying to achieve.
You're all about value. We've been talking value all day. I guess, could we sum up by just give me a concise view of your definition of value as it operates with Barrow Hanley?
So our definition of value is we want to buy good companies that are down for reasons we can identify and that we believe are temporary. And when you hear the word good, what does that mean? Well, sometimes it means a good quality company, but good in our view is companies that have had very competitive relative to the market rates of return, profitability, ROE. They've shown good track records and return on invested capital. They've shown to be just good management teams in general. And we want, earnings per share growth rates in line, certainly in line with the industry, but also the broad market. And so we're actually looking for good companies that have stumbled. We just don't want to pay a high price for them. Take some of these tech companies. We've been getting our toe in China here lately. We've been able to pick up a couple of big tech companies at half price relative to where they were a year ago. So we love growth. We just don't want to pay a lot. We want it to be value today, not value in 5 years from now.
Cory, thanks very much for talking to us today.
Thank you, Peter.